Good morning, all. Well, it's been a very weird week, and really what I expected, a week of very tight ranges and also a week of spreads doing not a lot but acting quite weird. I don't think the risk dial is going to teach us anything at all over the course of the next week or so, because now what we're doing is we're waiting for more data, and I'll examine that and the reasons behind it in the bond section. The main reason why bonds are going to be doing silly things in tight ranges for the next few days is because the yield curve has reached all my targets. So 2s, 30s are in the area that I think they are going to spend quite some time, like they did back here in 2019, doing not a lot and waiting for the moving average to catch up. So let's see what the situation is. The Fed has basically told us that they are going to cut two more times in 2024 and numerous times in 2025. What the yield curve is trying to decide at the moment is what the terminal rate is, and the likelihood is that it's somewhere around the 3 to 3.25 area. That is what the favored area is, where Fed funds are going to be, in which case, we have the twos around the 350, 360 area, which is not the ridiculous place for it to be. And it's most likely to be very sticky around this 340 area. It's going to find it very, very difficult to break below that in the twos. Certainly not for, any time soon, because whatever unemployment is, unless it's extremely cold. So if NFP is below 100,000, yes, we can go and test it, but are we going to stay below it? That is the big question. I don't think the twos are going to be doing very much of anything in the next few weeks even, while the 10s and 30s are, how shall I put it, they don't know how low the inflation rate can go, and therefore how much they can go down themselves, because the yield curve needs to normalize and go fully positive. I think that if inflation falls down to 2%, which I think is more likely than not, then 150 over is a reasonable place for the tens to be, and that would be around this 3.5% area. So I'm looking for a yield curve which completely normalizes, because inflation is going down, and 10s doing slightly better and 30s doing also slightly better. I think it's very unlikely that we see 30s above 419 anytime soon. That is a very good level to buy 30s, looking for something like the 390 to possibly even the 377 area. So 10s and 30s, I think, are at the moment stuck. I think the twos are also stuck. I think the yield curve is stuck. And until we get new data, we are just not going to be able to decide what the next steps are. Just to tell you, I think it's extremely unlikely, whatever NFP is, unless it's wildly outside of the expected ranges, and the expected range is somewhere around 140 to 150, that we are able to decide in the next week or so where we go next. Why? Because whatever the number is, it's extremely unlikely that we price in less than the 225 cuts the Fed has penciled in. And I think it's extremely unlikely that we can pencil in more than 250s. So whatever the number is, however cold or however hot, it's unlikely that twos can go much more than 20 basis points lower than they are here, i.e. around 330 or something like that, this kind of area, 335, they're always going to come back. And it's extremely unlikely that tens can go much below this 350 area. So we are in a wedging kind of situation, and we are waiting for the numbers, and especially CPI then, to tell us where the next big move is. I don't expect another big move until the middle of the month. The situation in Europe is slightly different, and this is why I prefer Europe to the US at the moment. I think that we can improve some more in the shats towards the 190 area, and that is because the yield curve is still steepening in Europe. I think that we can get to this -12, so that's another 7 basis points of steepening. And that is going to be my ultimate target. Once we get there, I think that Europe and the US can basically equalize their moves. The situation in Europe, especially after the inflation data that we got late last week on Friday, is that there is no inflation in Europe. So it should lead a bit more than it has at the moment. So twos, I think, let's have a look. We can go down towards this 191 area and stop. Fives, I think that we can definitely get to 187. And tens, I think that we can probably trade this 206 area and basically bounce off it for a bit, i.e. this 135.50-ish in the futures that we've found it so hard to break. I wouldn't be surprised if we break it a little and come back. But really the idea is that 2s, 10s is still steepening and still leading the shorter end, which is eventually going to make the 10 years come down as well, but it's going to perform far less than the front end, i.e. the shats and the bobble. I still prefer, especially now, I prefer Europe to the US in terms of price appreciation for the certainly until NFP, and then we see. But unless NFP is wildly out of line, I think Europe continues to lead. And that can be seen in the differentials. I would not be surprised to see the 5s around the 160 area. So that's another 4 or 5 basis points over the course of the next few days. And if we look at the 10s, I really wouldn't be surprised to see something like 168. So that's another 5-6 basis points outperformance. I don't think the outperformance comes from 10s doing nothing in the US and the bunds doing that much better. I think it's going to be a little bit of both, but not much from the US, much more from the bund side. And I think that once we're around here, that's going to be all she wrote. I don't think we trade 173. I think this kind of area, 168, 169, is going to be enough. 5-6 basis points before NFP is all you can expect. And then probably, if NFP is cold, then you can get a retracement. But certainly until NFP, I prefer Europe over the US. The one chart which is beginning to be interesting is the spread between the UK and Germany. As you can see, we closed the week, we broke the important level around the 180 differential. The likelihood is that over the course of the next few weeks we go to at least 2% differential. So every time this dips, I'll be a buyer of that spread looking for around here, around 2%. It's not a huge move, the risk reward is not huge, but it does look to me that fundamentally it's much more likely that this spread moves out towards the 2% area. And that's what I'll be concentrating on next week. Since I keep on getting a lot of questions on the September-December spread in the SOFA, I just want to go over my thinking again so it's clear to everybody. The yield curve is normalizing. The normal situation for spreads is to be positive. That is the normal situation. A normal curve trades up here. 7 basis points, 10 basis points positive. That's where it trades. And that is where we're going without a shadow of a doubt in my own mind. Either we're going to have recession by the end of Q1, beginning of Q2 of next year, in which the case the Fed cuts a lot and the curve goes positive, or we don't, and we have a normal curve with normal inflation around the 2% area, in which case we also get a positive curve, but at a much higher terminal rate. So these spreads, if you believe that the economy is normalizing, that unemployment is soft, that inflation is back at target, then you have to assume that you have a normal curve in either case, with recession or without recession. And if you have a normal curve, then the spreads trade up here. And especially September, December can trade at 50 over. I've seen it incredibly over because of the tightness of the turn, the projected tightness of the turn. So it can trade anything positive. It cannot stay negative. I think that that is extremely, extremely unlikely. And at any time that I see it at -7 or -7.5, I'm putting on more, because that is definitely, in my book, going to +6 to +12 in the course of the next 6 months. I must admit I'm getting a bit worried about the dollar, because it should be bouncing more with the differentials in between Germany and the US doing what they're doing, and it should really be trading up here and looking for the sell that I want to do around the 101.90 area. But it's not, it's remaining weak. And really, another 1 or 2 weeks of bouncing around, and then the possibility of a move much lower towards the 96 or 96.5 area really does become likely. I don't know why the dollar is this weak, but it is, and all it's doing by faffing around here is allowing the moving averages to turn and opening up the Bollinger Bands and making a bigger move down more likely. If we look at the euro against the dollar, it just keeps on staying there, and that worries me. I would have expected it to trade much more down here around the 110.60 area, and let's hope that for the next few days it does that, and it comes down a little bit. But once it has, it's likely to go higher. And as you can see here in the weekly Bollinger Bands, all it's doing is faffing around with the top around the top of the Bollinger Bands and allowing all these moving averages slowly to catch up. It's not looking good for the dollar, and that would explain why international equities are probably being favored at the moment, but we'll look at that later. Gold is still doing nothing wrong. When will it do something wrong? Well, it'll do something wrong if it trades 26.15, because I would have thought that the buyers should be around the 26.30 area. If it starts trading back to where it was at, the middle of last week and so on, it still hasn't done anything hugely wrong, because it's still trading above all the moving averages. But it's going to give you the first hint that it's not really all that strong at the moment. I think gold should retrace. I think that gold should trade around the 25.60 area, but I've been wrong for a while, so I wouldn't put that much weight on what I say. I think it doesn't make sense to prefer gold to tips, and I don't much like tips around 1.5%. So I just can't bring myself to buy more gold. I'm not selling what I have, but I just can't bring myself to buy more gold. Not a great week for DBC given what happened in China. Big Chinese stimulus, not so big Chinese stimulus, the market will decide. But certainly you would have thought that with the news that came out, DBC could have done a bit better because, if anything, the Chinese stimulus should encourage consumption, local domestic consumption, and if it does that, you would have thought that the factories producing the goods that these people are going to buy are going to need more commodities, more energy, more everything. And yet oil did absolutely nothing but go down, after a little spike. And DBC really closed the week absolutely unchanged. The only thing that went up slightly was copper. Really, the fact that it's industrial metals that have traded up slightly as opposed to energy, it tells me that the market is really quite undecided about this Chinese stimulus, and we'll have a look at a few charts later, but it's not being confirmed by every market that this is outright bullish and that there's nothing to worry about. So I'm very much in two minds. I think that 90% of the move in Chinese equities has probably happened over the course of the week. And this market is really saying that the world is not doing hugely well. The one market that I'll be looking at next week is in fact copper. If it starts retracing below here, 440, I think that the Chinese stimulus was a bit of a failure, and it really needs to start taking out this level, 474, to start even looking bullish at all. And those are the levels that I'll be looking at next week with China closed, because with China closed, I think the markets can actually decide by the end of the week which way the next move is going to be. So if the market starts retracing below 440, I think that the market has basically decided that it wasn't a very big deal. But if it starts breaking this 475 area, I think that then the market has basically told you that yes, this is not a complete dud. There's some kind of, importance to what the Chinese did. Let's start the equity review with actually EEM, because that's the one that is the most interesting. Now, I dumped my long position at 45.04 because, as you can see from all these tops, it's a very, very important technical level. The 200-day moving average is actually still negative, but there you have it. It's through the weekly Bollinger Bands, and let's see what it does next week. I think that if it cannot get anywhere near 47.93, it will retrace to 45.04, and probably it will retrace to lower than that. But I think the odds are shifting that in the next while, international commodities are going to perform better than US commodities. We're not there yet, not by a long chalk, but I think there are some initial signs that the spread relationships can begin to change. There's an opportunity for it. Whether it will or not is a completely different matter, but from now on, for the next couple of months, we have to look at those spreads to see what they're saying. So let's start now. This is EEM over SPY, and the trend has definitely not changed. The 200 moving average is as negative can be. Can it trade 83? Yes, I think it can. But if next week it can't break 83, much as if copper can't break the levels that I showed you, and the retracement is deeper than the levels that I showed you, I think the likelihood is that we come back down and retest. But we are a long way from where we used to be in EM, and as you can see how much it has underperformed. So I just get the feeling that the risk reward is changing. What is stopping me going all in on these equities are the fact that other markets are just not confirming. This is the emerging markets without China over SPY. And that market hasn't even crossed the 200-day moving average. Now, are the odds really improving down here? Yes, but the technical signal has not been given. So I've only shifted like a couple of percent from the US into this kind of ETF. And this is ACWX. So this is mid cap and large cap international without the US. So it's the ACWI index without the US companies in it. And as you can see, that is still very, very negative. Every time, it's had many false dawns, but it's never really managed to turn the 200-day moving average for long. But something which has outperformed or slightly rather underperformed as much as this index over the course of the past 10 years. I mean, let's go and have a look. Since 2009 we were at 35, we're now at 10. So the odds of it turning eventually are going to be much better. If next week we start filling and all we do is we stop around the 99 area and then go again, I think that at minimum this is an ABC then, and at minimum we see these kinds of levels around the 1040. So it tells me that the odds of these markets outperforming over the course of the next 2 or 3 months are pretty high, unless they completely turn around. What does that mean for the SPY? It probably means that it's in a range, but also with a downward bias. And that would make sense until we have the elections in the US. Until then, and until I've seen the policies of the winner, because let's face it, they haven't really told you many policies. I think that the odds, the risk reward favors buying dips in ACWX, dips in EMXC, dips in EM over SPY. So every time there's a dip, you sell some of your holdings in the US and you buy some of your holdings in international, because for the next 40 days or so, the odds are that we do bounce. I find this monthly chart especially absolutely fascinating. This is the stocks. I've been saying for a while that really this 48.50 is the area to watch, and never have we closed a single month below 48.50. We've had ranges below it, but not a single monthly close, and now we're going to get a monthly close really just about at the all-time highs, which has opened up these Bollinger Bands, and 5200 is the possibility. And this ties in with what I've been saying about ACWX, which has a lot of European components. Emerging markets naturally doesn't, but ACWX certainly does. And this is another reason why I think this market could start outperforming the US, or certainly performing in line with the US, i.e. not underperforming. This to me says that we're going higher, and it would make sense to have some rotation into international stocks just before a US election and even after a US election, because the outcome is perceived by markets as not being that because the outcome is perceived by markets to not be that favorable, or it has been discounted, which is another possibility. So what I'm saying is definitely put some money in foreign stocks. Don't keep it all in US. It's not making a lot of sense at the moment, and the charts are telling you that other markets could easily outperform the US in the short term. Let's try and triangulate that with what the US is doing, and especially interesting is the weekly chart. And it's basically crawling up with the top Bollinger Band. This is typical wedging behavior because the market really can't do much better because the weekly Bollinger Band is on top of it. And it really doesn't want to do much worse because it doesn't know the results or what is going to likely happen during an election or for the NFP numbers. So that tells me that we are in a range. Next week we're going to have 57.90 as the top of the Bollinger Bands, and really it's very unlikely that we go below these levels, which are around the 56.60, 56.70 area. Very unlikely that we can sustain any big move down before NFP. I do think the first reaction on Monday is going to be slightly lower, but I don't think it's a very big thing. It's a tactical thing as opposed to a strategic thing. Until we get the election out of the way, I think this market is going to be very constrained within ranges. And that gives the possibility for other markets to do better if they want to do better. Other markets really should try to do better while the US just goes sideways for a bit. And why should the US go sideways? Well, unless tech leads it, it's extremely, extremely unlikely that the other 490 stocks can take the index very much higher. Yes, the rally in the US is broadening to the other 490 stocks, but there's only so much heavy lifting before an election they can do if the NASDAQ stocks, i.e. the Magnificent Seven or whatever you like to call them, does not participate. And this seems to be a market very much stuck within tight ranges. What did we do? We went here, we filled the gap to the, basically to the tick and came back. This is not a trending market. This is a market where dips will be bought, and absolutely any kind of dip towards 19,500 is going to get bought because this market is just not going to fall apart. But it's not a market which is trending strongly higher. So I am not all that positive on the US next week. I think it's another week of tight ranges. I can't really see SPX above 57, 80, 90. It's unlikely to be able to sustain that before NFP. And after NFP, why should a hot number really favor stocks? Because the multiplier is going to be going down. So to me, we are, absolutely gasping for air at these levels in the indices in the US. What I found interesting on Friday was this little move here in the VIX higher. And I do think it makes sense that the VIX should lead up into the election. I don't think it means that the S&P falls apart. I just think that people are buying options, hedging themselves. And I think we get this kind of behavior. I think that 20 is likely to trade again in the VIX, but I don't think that the damage that it will do to the XPX will be that huge. But some damage it will do. And it's another reason why I think that we are basically starved of oxygen at these levels in the indices. I just can't see strong sustained moves higher. I can see 0.5%, 1% squeezes. So the market goes up 30, 40, 50 and then gives up 70. That's the kind of behavior that I can see. I really don't want to be a buyer of SPX at these levels until the election is cleared up. What are the big level takeaways? I think it's extremely, extremely unlikely that the yield curve in the US does anything at all next week. Maybe it corrects some before NFP. And unless NFP is below 110, let's say, or above 175, we're not going to get big moves in bonds. I think you can continue being a seller of out-of-the-money calls in bonds. And certainly until Friday, the net move in the bond market should be very, very small. The yield curve is only leading in Germany, so I still prefer Germany over the US for another 5-6 basis points, which basically means that the bonds can get up to 135.50 and slightly higher and then come back. They should not be constrained by NFP as much as the US. SPX, I'm getting less bullish of at these levels, and I'm beginning to prefer other markets, other non-US markets, because I think there is a decent likelihood that they have a 2, 3, 4% outperformance over the course of the next couple of weeks against the US, which certainly makes sense and ties it in with what volatility is doing in the US and is not actually doing in Europe and in other places. So that is all I've got for you. I will naturally tweet to you on Monday, and I will write up my thoughts for NFP on Thursday once we have more definitions in the charts. Have a wonderful Sunday.